Hi, and welcome back to Hedge Fund Manager. Let's do a summary of today's deep dive into the pharmaceutical company AbbVie. We concluded the last fundamental section where we tried to forecast fundamentals and valuation multiples with concluding that we should pay attention to EBITDA because it was more stable than the other variables, and it's also is not affected by whatever accounting standards seem to be affecting EPS, for example. It might be a little fraught with error or uncertainty and risk to go all the way up to the EBITDA level. But remember, again, these deep dives, they are not actual company research products. These are here to show you how to use the method, what the general principle of doing a deep dive is. And if you want to actually put your money to work in a company, investing your hard-earned money, then you need to do a little bit more work. But we will come to how to do that in the future. And as you can tell when we have been going through AbbVie here, there are many risks of error looking at variables that do not exhibit stable patterns, not the least. But here, looking at EBITDA, after a strong run-up for maybe a decade or more, it has flattened out. I have no idea what that means in terms of their patents or competition or whatever is happening with Medicare and Medicaid in the US, for example, or global standards of pricing for generic pharmaceuticals and whatever AbbVie is selling. So there are so many details that we could get into in terms of forecasting their actual likely future sales growth rate and earnings. We can also see here that the EBITDA margin, although it's pretty stable, at least it's been above 42 and below 50%, it's close enough. And lately it's been falling from 50 down to 48%. That is stable enough to not have to fret too much about the details here. You would probably expect, looking at this chart, that EBITDA margins will keep coming down by a little bit in the coming years, but probably not too much, because even in their poor years before whatever happened here in 2020, they managed to stay at least 42%. I would expect, if I looked into whatever is going on here, that there was an acquisition or a new product or something that made them take this step up, or maybe a change in accounting standards. Whatever the reason, they seem at least to be pretty stable, slightly falling from the current levels. So we'll go with EBITDA. As we saw also earlier, sales growth unimpressive. You could probably expect it to fall slightly. Let's look here. Let's check financial analysis again. Highlights, revenues and revenues growth. If I hover about revenues, they seem to simply have flattened out here, and I would not expect them to reaccelerate in any meaningful way. At least I would not make such assumptions unless I had something tangible to go on in terms of whatever actual products they are selling and in which regions and at what unit prices, all the things that go into an actual detailed sell-side analyst forecast. But we at least we could see that sales probably they will just grow with inflation unless something new happens. EBITDA, considering margins were falling slightly, I would say that the actual EBITDA level, so that would be sales times EBITDA margins, that would be more or less flat going forward. The EV to EBITDA level, so the valuation multiple, let's see if we didn't have it. Yeah, here it is. At its troughs, it were down at around 10, and it's been up at around 16 in good times. The average being somewhere here around 13. It's currently at 14. So probably there is a risk of it falling a little bit, and that would also be pretty logical and plausible given their poor growth rates and slightly falling margins, which creates a bit of an uncertainty and at least it doesn't look like it's a successful company that you want to tag along. Rather, if to buy this one, you would want it to be really cheap. So we have EBITDA flattish, EV to EBITDA perhaps slightly negative. So we have kind of a slight negative total compound average growth rate before dividends. And then let's take a look at the dividend yield. It's also been coming down. We're now at 3.6%. If you're wondering where I can find that, it's snapshots in Koifin. Look at the overview. Here you have almost all the variables you would want for a quick view of a company. Down here, for example, you have the analysts' estimates. In terms of sales, they are actually a little bit more sanguine than I am. They are at 6-7%. Maybe that could cause us to adjust slightly upward, whatever I was estimating before. And in terms of earnings per share, they are definitely more positive and optimistic. But well, if I hover above the number here, I can see how they have changed there in this example. 2027 EPS estimate, slightly creeping upward. Maybe this is something to pay attention to, because if this is something that is well, has a firm base in reality, then a stock price of 180 versus a pretty quickly rising EPS of 15, that is only like a 12 times price earnings ratio and growing EPS, that actually sounds kind of attractive and interesting. Anyway, we were talking about the dividend yield. It's up here, hover above the number 3.58, and you'll see whatever the dividend yield has used to be, and this can serve as our estimate going forward. So let's say 3.5%. All in all, this creates our total CAGR for an investment in AbbVie. So the three variables: F, fundamental; V, valuation level; and D for dividend. It comes together to just a 2% total CAGR, which is very poor. I mean, remember, we would want this to be at least 15%. So even if we increase the EBITDA estimate to, let's say, 5 more points, then we're at 7% per year. That's still very poor, so there's no real way of saving this investment idea in any way that I can see. And then finally, we want to make some kind of a risk assessment. Remember, risk is relative to either other investments that you have in your short list, or to the average market. You just try to make a subjective call on if it's more or less risky, and that is if it's more or less certain or uncertain, if you are regarding whether they will permanently miss your forecasts. Remember not to use unlikely things for your forecasts. That just creates more uncertainty and a higher risk that you don't really have taken into account. So all in all, this looks like a really poor investment.